Joining me now, Bulltick Capital Markets Chief Strategist Catherine Rooney Vera, Michael Lee Strategy Founder Michael Lee, and Payne Capital Management President and Payne's Points of Wealth podcast host Ryan Payne. Catherine, let's kick things. Get Michael's take on what the Fed did last week. The Fed's dot plot is laughable. Please tell us more, dear sir.
Yeah, Dagan, you and I could take a handful of my children's sticky toys, throw it up against the wall, and be just as accurate in predicting where interest rates are going. This dot plot has been a nonsense exercise for the Fed for some time now. The fact of the matter is we're so far away from any tightening measures from the Fed. There's $750 billion in reverse repo being posted at the Fed, meaning that the Fed has posted so much liquidity, there's not enough shelf space at the major banks and broker-dealers for $750 billion of securities that the Fed needs to hold on to. This means that the Fed can reduce their balance sheet dramatically without it having the remotest bit of tightening effect. And if you play that out, we're buying $120 billion worth of bonds a month, and so if they were to reduce that at $10 trillion a month, which they haven't announced yet, Dan Niles was on the show a few months ago saying he expects that announcement to come later this summer at Park City or wherever they have the summit out west, that they're going to start then. But even then, the taper is bullish because it's going to remove some of the clogging in the underlying plumbing of the Treasury market right now. So, and then you have an $8 trillion balance sheet. So at what point are they going to stop reinvesting interest and principal as bonds come run off? That's to the tune of $200 billion a year. And then only after both of those things are done are they going to start raising interest rates, which means you're 8 to 10 hikes away from actually being in some sort of restrictive Fed policy. So we're so far away from any sort of restrictive policy. I think we're near the point where this accommodation is in the diminishing marginal returns. And so I would say that this dot plot is purely an academic exercise. There's little or no accuracy to it because there's so many variables that can be changed between now and then, and no one wants to acknowledge the elephant in the room that after a while this excess accommodation doesn't really do anything. All it does is sit on bank balance sheets and commercial checking accounts, and now there's not even room for that at the big banks. It's all being put back to the Fed. So I think I'm a little bit different than Catherine here. I favor technology. I think the world's coming to the realization we're in a low-growth, low-inflation world, and in that type of world, technology companies that can grow their revenues by 20 and 25% and their earnings by 50 or 100% are simply worth more than the rest of the market. I think with all this liquidity, a lot of asset classes are going to participate because there's simply nowhere else to put money. But again, I'll reiterate that dot plot is effectively useless.
Low growth, low inflation right now. Well, I think people would love to see some of that low inflation if you're filling up your car. Ryan, let's get